So, good morning to everyone. I first of all want to thank all of you showing your interest to joining this particular course. This is going to be a very extensive course, and because it's a crash course, so we'll be starting with, what exactly the trading is, what are the benefits of trading, why we should trade, and we'll start with the basics of candlesticks charting. After that, we'll check the overall patterns which will ensure our entry or exit points into a particular trade. We will also check what are the common mistakes that traders do, what are the loss making strategies that we usually follow and end up making more and more losses. By the end of this particular course, you'll get an idea of overall trading, how it should be managed, how the charting can be done. So we will begin with the course. In case you have any questions, what you can do is you can write those questions on a piece of paper, or in case a notebook that you have. PPT that I'm going to use during this session will also be shared with you in the PDF format. So you don't need to take extensive notes, but in case you want to do some additional notes, maybe which are not part of the PPT, maybe you can try to take those notes. But apart from that, I don't think you'll require any kind of special noting. Let us begin with this course. So goal of this course is to bring focus to your trading. Okay, so this is very important slide here. We are going to talk about the annual returns that investment can give. So you can see in the first column, these are the number of years, and in the second column, what we have is the number of, in the second column we have 15% as the annual returns, which is basically promised by many mutual fund companies or agents. Here we are talking about let's say 30% as the annual returns. Now this is excluding the inflation rate of, let's say, 7.35 or 7.5%. Okay, now if you just assume 7% as the rate of interest, sorry, the inflation rate, so you can see that here you'll have maximum gain as 8% annually. Now we know that trading or buying or selling securities carries a certain amount of risk. So 30% every year may not be possible. Okay, some year you might get your portfolio 100% or 200% returns. In certain years there might not be any return. In fact, we might incur some significant loss. So we are talking about the CAGR, that is compounded annual growth returns. So if we assume over a period of let's say 25 or 30 years, somehow if we achieve 30% as the return, you can see the significant amount or significant impact over the years. So in the first example, I am pretty sure most of us have invested in some kind of mutual funds by now. So let's say in the year one you invest 30 lakhs rupees. Okay, now these 30 lakhs, let's say we get 15% as CAGR. So in the 29th year, this amount will increase to 15 CR. Okay, again, we are not considering inflation rates over here. But let's say you start with a very handsome or very humble capital for your trading, let's say of 1 lakh rupees. So with just this 30% annual returns, you can still achieve the same effect in the 29th year. So why 30% is achievable? First thing is that the trading decisions will be completely in our hand. So all the entry points, exit points, it is something that we can cover. Now, because mutual fund companies work on a very large scale portfolio, okay, they have a different strategy. They also need to comply with regulatory guidelines. So they have certain level of instructions. They cannot clearly plan or clearly exit at a particular day or time, even when they know that the market is going to crash. Even in those periods, they might not be able to wind up their position. But when we manage our own portfolio, we can definitely do that. Now it's not necessary that we should completely avoid a mutual fund, but from your overall investment portfolio, maybe some portion you can allot to, let's say, mutual funds, and some section you might or some investment amount you can use for your trading portfolio. Okay, There are certain benefits of mutual funds. The first one is, of course, that it is kind of a passive investment. You invest and you are not going to check regularly what is happening with your mutual fund portfolio. And because it's a passive kind of returns that it can give 50%, so it makes sense to have some amount of investment done in mutual funds. I personally am not very big fan of mutual funds because of the sheer nature of how those are managed in India. But I think we can start with the smaller amount. Let's say you can start with a lakh rupees, and then once you get confident in your trading, you can start increasing the amount of investment that you can do in your trading section of your overall portfolio. So about this course is for absolute beginners. In case you're already aware of charting techniques or technical analysis, this would be at least the first session could be a good revision. Maybe I can add a few additional points, and those could be beneficial in your trading. After this course, you can plan to become a positional trader or a intraday trader, or you can even plan for short term, medium, or long term trades. Okay, so the study that we are going to do is generic in nature, and after that you can just plan on which time frame or on how much of the investment horizon you want to work. And after that you can just choose whichever working the best for you. So intraday takes a lot of time because you have to be in front of the computer throughout the trading sessions, or at least your trades are, at least when you're taking some position into a particular trade. However, positional, or these kind of trades which basically you create a position, let's say today, and your trade will be active, let's say for 3 or 4 months, or maybe 3 or 4 years. So those kind of trades or those kind of investments are basically again passive in nature, because you're not active in the market. You are probably going to do your study after market hours, and take your position on the next day. And at once a target or a stop loss level is reached, you will exit your position. So that will be up to you. So every trader has his own trading style. So everybody cannot be intraday trader. Everybody cannot be a positional trader, because positional again requires certain level of patience. Intraday requires quick action and quick decision making. So this completely depends on your whatever your behavior patterns has been so far. And after few trades, or after few initial trades, you'll get to know that whether you suit in the category of positional trader or an intraday trader. We will learn about the overall trend analysis. So we all know that when markets are going up, so this is uptrend, this is downtrend. Okay, now here we can buy, here we can buy and sell, and here we can sell and buy. We will get to know what are the different trend analysis. And this particular study of technical analysis can be applied anywhere. Okay, so recently we have been crunching numbers on COVID numbers as well. So of course it might not give a clear picture, but at least we'll clearly understand whether the cases are rising or going down. Similarly, we can get to know about other type of investment. Let's say land rents, let's say per square feet rate in, let's say, Mulund area, or let's say Kulaba. And after doing some charting on these numbers, you'll get to know that whether the prices are going up or down over a period of time. Similarly, it can be applied to commodity trading, or currency, in case you're into currency market. Okay, so this particular study can be applied anywhere. Okay, most importantly, TA, or technical analysis, is a very good tool for decision making. Most of the time what we do is we consult a few of our friends, or our colleagues, or we usually try to search, let's say, what are going to be, or the real estate rates in Mumbai are rising or coming down. So we just try to search this kind of information. And so information is available everywhere, but what matters is what data that we have and what analysis that we do based on that data. So technical analysis is a very good tool for doing that analysis, and helping you to arrive at a decision. I'll quickly tell about myself. I'm a business owner since 2010. I'm mainly into technology space. So I personally have tech experience of 12 to 13 years. I'm basically automation expert in web and mobile platforms. I got myself certified from NSC as a technical analyst. Since that, I've been started my trading, and now I'm gradually moving towards algo trading. So all the slides or all the information that I'm going to share through this course, so everything is tried. I have personally adapt those technologies or the studies that I do, and all these studies are practiced by myself. I have tried these studies in my business as well, while doing my personal finances, also in my investment. So a few couple of examples. So last year I had assigned a significant portion to gold ETFs, and those have given me handsome returns in this particular year. Also in business, I had in the very early stages, I think in the first half of 2019, I had done some analysis about into the credit crunch that was in India. And I think by Jan, I had completely exited my mutual fund portfolio, and I think in the middle of Feb month, I had completely exited my stock market portfolio. Apart from some stock in the portfolio, I think most of the trades I had exited. And we know that after that what has happened, that market crashed by 40%. Okay, so I think similar knowledge you can also gain by studying technical analysis. So it will save you from losses, and it will also help you increasing your capital over a period of time. What a technical analysis does is it provides you a stream of additional income, because let's say you are positional traders and you're going to take long-term trades in terms of let's say assuming you're taking trade for let's say 3 to 6 months. Okay, so some study you'll do today, you'll take a trade tomorrow, and maybe after 3 or 4 months you can exit that trade. So your money has been working for you for let's say 3 or 4 months, and it gives you substantial returns, maybe 10% or 100 or 200% in some cases. It becomes a part-time side activity as well. In case you're a positional trader, you just need to carry over your positions, that is you buy and you carry your position for months, days or weeks. Positional trading becomes relatively less work and less risky. So I personally am a positional trader. I hardly do any intraday trades. But in case you're keen on working as an intraday trader, you can work smaller time frames. So this particular thing maybe you'll not be able to understand now, but you can work on smaller time scales, and you can quickly get daily income or profit from a certain trade. Maybe you'll be in the trade for 15 minutes or let's say 3 hours maximum in a day. But this becomes a full-time activity because you have to be in market every day. Most important point is your capital would be safe, okay, in intraday. For example, let's say last week markets were very tough, okay, and you took a trade on Monday, you exited whether in profit and loss on let's say on Monday afternoon, and next day you're not technically carrying any risk as such. So let's say because you ended your position on Monday afternoon, so on the Tuesday morning you're not carrying any risk as such, okay. However, let's say you took a positional trade let's say 2 weeks back, and let's say last week has been tough for markets, okay, so you might have incurred losses, but those losses are notional, as in you're not booked your losses yet. So let's say from Monday, let's say markets are going to rise up. Okay. So the notional loss is not going to make any significance in your positions. Okay. However, in case of, intraday, you might not be part of a substantial gain that a stock can give. Let's say there is a stock which you buy today and it rose up by 5%. Okay. So you took your intraday and you cut your position here and you book the profit of 5%. Okay. Now let's say next day it rose up by 15%. Okay. So let's say this was because this was your positional trade. So you might have lost on this particular move. There are pros and cons of both styles of trading, so whichever fits best for you, and this is something that you can explore over a period of time. Let's say after your 10 or 15 trades, or let's say 50 trades, you'll get an idea what could be your style of trading. Technical analysis also helps you with faster entry and exit, especially trading in capital markets. There are certain benefits. Okay, so if you just compare the type of investment with real estate market, you know that you can you'll require a time of, let's say, 30 to 45 days to buy a particular property. Exiting could be more difficult, considering what are the sentiments in the market. Okay, so real estate obviously takes time to enter or exit as an investment. Business investment, we know that we have to create a certain business, we have to build a certain product and service, so which is again a huge investment. Then you have to spend a lot of time in marketing the stuff. Then substantially you have to also stay in line with regulatory bodies and build a healthy business. Okay, of course the returns could be huge in case your product or service is really popular in your customers. But this again takes time. Maybe again certain business could give, let's say, 25 to 30% CAGR over a period of time, or could be 100% every year. But again, this depends on business to business. But again, this will take time. Again, you are going to let's say start up working on a new idea, again that is going to take time. Physical gold, you buy the gold, it sits idle, it's not doing anything unless you're wearing the gold for a party. But apart from that, there are no technically benefits of physical gold unless the intrinsic value of the gold itself changes. So if you know that, you might have noticed that from 2009 till 2017-18, gold has been moving sideways. The price has not increased significantly. It was only the last 12 or 16 months wherein the price has gone up significantly, and that is why there are different types of investments. But again, entry and exit could be difficult in all these cases. So we know that risk is everywhere in all types of investments. So it's not only that the stock market is the riskiest place in the world, but the sheer nature of the trades that we take or the investments that we make in stock market brings it makes it just shows that the risk is higher. Okay, but however, if you are able to manage the risk well, I think we can surely be able to do the trading very well. The most important thing is that we are always trading. Okay, we are always doing buying and selling decisions. So this knowledge will be really helpful in case we are doing to do some very big ticket investment. Let's say you're planning to buy a house, or let's say you're planning to buy a new car. Okay, so for that company or for that particular brand of car, you'll get to see what are the prices, so or what has been the price points. Okay, so working on only so when we do a buying decision, what we generally check is, okay, the price has been increased by 10%. Okay, so initially the price of 100 rupees and now it has gone to 110. Okay, but if we increase the number of data, let's say the price was initially 120 rupees, and then it has decreased to 90 rupees, and now it has increased to 110. So what we usually do is we usually work on these two numbers. Okay, the last two numbers, that is the price has increased by a certain number. If we compare these two numbers, okay, we'll get to know that the price has technically decreased over a period of time. So let's say this was 120, then the price has come down to 90 rupees, and then it has gone to 110. Okay, so now if we work on this data, we will find the car as cheaper. Okay, so across these buying decisions, we might make use of the trading strategies as well. Okay, so it's really wise to get better at our trading decisions or our buying and selling decisions.